Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. Welcome. In this session, we're going to delve into a critical aspect of corporate finance, planning for capital investments. We'll be dissecting the rigorous process that corporations use to evaluate and ultimately select those major long-term projects, the very decisions that truly chart the future course of a company. So picture this. A new factory costs $10 million. A new software system costs $5 million. How does a corporation formally decide which projects to fund, or if it should fund any at all? Well, this is the fundamental question of what we call capital budgeting. It's an absolutely critical function that shapes the future of any enterprise, really forcing disciplined choices when it comes to allocating those scarce resources to maximize shareholder value. All right, so here's our roadmap for this discussion. We're going to proceed in a very structured way. First, we'll lay the groundwork by looking at the capital budgeting process itself. Then, we'll dive into the specific quantitative techniques used for evaluation, things like payback period and discounted cash flow. After that, we'll look at an accounting-based method, the annual rate of return. And finally, we'll wrap up by considering some of the real-world refinements and challenges that complicate these decisions. Okay, let's begin with Section 1, the capital budgeting process. Now, it's absolutely crucial to understand that before a single number is crunched, a company needs a solid, structured process. This framework isn't just bureaucracy. It's essential for ensuring discipline, strategic alignment, and the rigorous vetting of every single significant capital expenditure. So what exactly is capital budgeting? Well, at its very core, it's the process of making these huge capital expenditure decisions. It's all about the strategic allocation of a company's financial resources. You see, the goal here isn't just to spend money. It's to invest it in projects. Think new machinery, advanced technology, entire new facilities that are going to generate significant, sustainable value over the long term. This process typically follows a clear four-step path. First, project proposals are requested from various departments and plants. Then, a capital budget committee screens those proposals. After that, company officers determine which projects are actually worthy of funding. And finally, the board of directors gives the ultimate approval. What you should notice here is the dual flow. Ideas bubble up from the bottom, from the people who need them, while the approvals cascade down from the top. This multi-layered scrutiny is designed to ensure every potential investment is examined from all angles. Is it operationally feasible? Is it financially viable? And does it fit our overall strategy? All right, now that we have the process down, let's move into Section 2 and start looking at the tools. We're going to begin with our first quantitative method, the cash payback technique. It's probably the simplest measure out there, and it's really valued for its straightforward focus on two things: investment recovery and risk. So what question does the cash payback technique answer? It's really simple. How fast do we get our money back? That's it. It identifies the time period required to recover the cost of an investment from the net annual cash inflow that the investment produces. And, the general thinking is the shorter that payback period, the less risky the project is. Okay, let's look at an example. And this is where a really important detail comes in. We start with an initial investment of, say, $200,000. The expected annual net income is $25,000. But, and this is key, net income is an accounting figure, not a cash figure. It includes non-cash expenses like depreciation, which here is $20,000. For this analysis, cash is what matters, so we have to add that depreciation back to the net income to find our net annual cash flow. In this case, that's $45,000. To get the payback period, we just divide the initial investment by that cash flow, and we find it'll take about 4.44 years to get our original $200,000 back. So is this a perfect method? Absolutely not. It has some clear strengths and weaknesses. On the plus side, it's very simple to calculate and understand. It's also a pretty handy initial screening tool for risk. The quicker you get your money back, the less exposure you have. But it has two major weaknesses. First, and this is a big one, it completely ignores the time value of money. A dollar today is not the same as a dollar 4 years from now. Second, it overlooks any profitability after the payback period. A project could be a cash cow for 20 years, but this method doesn't care about anything past year 4.44. And it's these significant flaws that lead us to more sophisticated techniques. Which brings us to Section 3, discounted cash flow, or DCF methods. Now we're advancing to what are widely considered the most conceptually sound approaches in capital budgeting. Why? because they are grounded in one of the most fundamental principles of finance, the time value of money. The idea that a dollar today is worth more than a dollar tomorrow. The first DCF method we'll look at is net present value, or NPV. The idea here is to figure out how much value an investment adds to the company in today's dollars. What we do is we take all the future cash flows the project is expected to generate, we discount them back to their present value, and then we compare that sum to the initial capital outlay. If the net present value is positive or even zero, the project is considered acceptable. Let's work through an example. Suppose a project requires a $130,000 investment today. It's projected to generate a net cash flow of $41,000 every year for 10 years. Now, you can't just multiply 41,000 by 10. We have to discount those future cash flows using the company's cost of capital. Let's say it's 12%. Think of that 12% as the minimum required rate of return. When we do the math, the present value of those future inflows is actually $231,731. We subtract our initial investment, and we get a positive net present value of over $100,000. Because that number is positive, this project is a go. It's expected to earn more than the required 12% return. Now, a close cousin to NPV is another method called the internal rate of return, or IRR. It's a bit different. Think of it this way. NPV answers the question, how much value does this project add in dollars? IRR, on the other hand, answers the question, what is the project's actual percentage rate of return? The IRR is the specific interest rate that makes the present value of all those future cash flow inflows exactly equal to the initial investment. In other words, it's the rate that makes the NPV equal to zero. So, NPV versus IRR, which one is better? Well, the NPV calculates the absolute dollar value that's added to the company. The decision rule is simple, except if the NPV is greater than or equal to zero. The IRR, on the other hand, calculates the project's percentage rate of return. The decision rule there is to accept if the IRR is greater than or equal to the company's required rate of return. Now, while both methods often point to the same decision, most academics and practitioners agree that NPV is generally superior. And why is that? Because it gives you a direct, unambiguous measure of how much value in dollars is being created for the firm. Okay, let's shift gears a bit for our fourth section. We're going to look at a method that actually departs from cash flow analysis altogether and instead uses accrual accounting data. This is the stuff managers are used to seeing on the income statement. This method is called the annual rate of return, or ARR. And what it does is it measures the profitability of an investment using that accrual accounting data I mentioned, specifically the expected annual net income. It compares that net income to the average investment over the project's life. So unlike the other methods that are all about cash flow, this one is based on the numbers you'd find in an income statement, which makes it feel very intuitive for a lot of managers. So how do we calculate it? It's a two-step process. First, you need to find the average investment. You take the original investment, add any salvage value at the end, and divide by 2. In this example, that's $130,000 plus 0 divided by 2, which gives us an average investment of $65,000. Step 2, you take the expected annual net income, which is $20,000, and divide it by that average investment. So $20,000 divided by $65,000 gives us an annual rate of return of 30.8%. And just like with IR, that percentage would then be compared to the company's required rate of return. Okay, we've covered a lot of quantitative models, but here in Section 5, we need to talk about the real world. Because these models, as powerful as they are, have limitations. Relying on them exclusively would be a huge mistake. Really sound decision-making requires us to acknowledge those limits and to address the complexities and challenges that you just don't find in a textbook. And here's a perfect example. How should a company account for non-financial factors? Things like enhanced safety for its workers, or improved product quality, or even just a boost in employee morale. These are what we call intangible benefits. They're incredibly difficult to put a dollar value on, but they can have a substantial financial impact down the line. If you ignore them, you might end up rejecting a really valuable strategic project. So what do? Well, you don't just throw your hands up and ignore them. There are a couple of practical ways to handle this. One approach is to calculate the NPV without the intangibles. If it comes out negative, management then has to make a judgment call. Are those intangible benefits worth at least the amount of that negative NPV? Another way is to try and project some conservative, rough estimates of the value of those benefits and then incorporate them right into the NPV calculation from the start. Here's another real-world issue: capital rationing. What happens when a company has, say, 5 great projects, all with positive NPVs, but only has enough capital to fund 2 of them? How do you rank them? For this, we can use something called the Profitability Index, or PI. It's a method used to rank projects, and it's basically a bang for your buck calculation. It's the ratio of the present value of the future cash flows to the initial investment. An EPI greater than 1 is desirable. Let's look at this table. We have Project A and Project B. Both are acceptable investments, but maybe we can only afford one. Project A requires $120,000 and has a profitability index of 1.13. Project B is a bit bigger, requiring $160,000, but its profitability index is 1.16. So even though both are good, Project B is the more attractive option here because it generates a higher present value for every single dollar we invest. Finally, let's talk about what happens after a decision is made. The calculation might be complete, but the work is not. So how does a firm ensure accountability and actually learn from its decisions to get better in the future? The answer is the post-audit. This is a crucial final step where the actual results of a project are compared back to the original projections. A post-audit is absolutely essential. It fosters accountability, it lets you make course corrections if needed, and maybe most importantly, it helps you refine your estimation techniques for the next round of investment proposals. It really creates a cycle of continuous improvement.